I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, crowdfunding, direct lending, and uninstitutional borrowing, is a continuation of many symposia we've had over the years where the limited partner steps in to replace the banks. The drumbeat over the last year and a half has been signaling the evaporation of commercial lending as banks strive to increase their capital ratios. Naturally, this is all affecting different sectors of the economy, and our speakers are all the very best practitioners in their respective specialties, all very different from one another. I'll introduce them in alphabetical order. After I say this, the speakers' views are their own and don't necessarily represent the views of the roundtable. Bob Conrads is the founder and chief investment officer of San Francisco-based Colchis Capital, a direct lending partnership with $1.2 billion of assets under management. Colchis strategy provides credit to underserved prime credit consumers. Between 2006 and 2009, Colchis managed a dedicated fund to short junior subprime RMBS bonds through CDS instruments, and in 2008 launched a series of 6 closed-end funds to purchase distressed RMBS bonds. Before Colchis, Bob was senior partner with Sienna Ventures, an early-stage venture capital firm. Before that, Bob was managing director at First Boston Corporation, where he ran that firm's global investment banking technology group. And before that, Mr. Conrads was a senior partner at McKinsey & Company, running their electronics industry practice. Earlier in his career, he conducted research in atomic and molecular physics for the U.S. Atomic Energy Commission. Sitting next to Bob, Andrew Milgren. Excuse me, Bob, are you next to him? Oh, you are. I write this ahead of time. Andrew Milgren is managing partner and chief investment officer at Marblegate Asset Management, a resident of Greenwich, a special situations hedge fund based here in Greenwich. Before that, he was a principal at Epic Asset Management, where he ran a portfolio of distressed and special situation assets across a broad swath of industry sectors, as well as coordinating that firm's overall research process. Coming with the territory, Andrew has sat on a variety of official and ad hoc credit committees and has been deeply involved in a number of corporate restructurings. Before Epic, Andrew was in the capital markets teams at Deutsche Bank, Bank of Tokyo Mitsubishi, and Swiss Bank Corporation, formerly now known as UBS, where he was part of the emerging markets team responsible for prop investments in Russia, Africa, and the Middle East.
I am also a nuclear physicist.
We've got 2 of them today. And finally, Andy Stourman is the head of middle market lending and late-stage lending at Golub Capital, a New York-based direct lending partnership with over $10 billion of assets under management. Andy is a member of the firm's investment and watch list committee. Before Golub, Mr. Stourman was a managing director at Albion Alliance, where he originated, executed, and supervised subordinated debt and equity instruments for 2 private partnerships. Before Albion, Andy was a vice president at Bankers Trust, Alex Brown, and an investment manager with the New York Life Insurance Company, specializing in private security investing. At New York Life, Mr. Stourman was a senior member of the private equity group, managing leveraged senior loans, mezzanine investments, private equity securities, and limited partnership assets. Finally, Jeff Silverman is the moderator of the Greenwich Roundtable today. Jeff is an old friend of the Roundtable and the president of Alpha Parity. Please welcome Colonel Silverman as he sets the table for us today.
Thank you, Steve. Thank you. Today's topic, crowdfunding, direct lending, and uninstitutional borrowing. I guess the only term missing is shadow banking. Today's practitioners that we've assembled are all engaged in lending or investing in loans one way or another that are essentially filling the gap that has been left by the commercial and in some cases the investment banks. The concept is not new of shadow banking, certainly not since the financial crisis. Many hear about firms doing peer-to-peer lending, firms like Prosper, Lending Club, originating over $6 billion worth of loans over the last 6-7 years, and other types of loans. But As LPs, hopefully what we can all take away from today's session is, what should we all consider as we look to access this strategy, and where are the opportunities today, tomorrow, and above all, what are the risks that an LP should consider? So with that, I will kick it off to my left, and Andy, we'll let you.
That's great. I was hoping to go after Andrew because he's going to trash me when we're done. So we did the prep, and he's the distressed, and I'm the front end. So he tends to clean up what my competitors do badly, not what we do. Boy, I was prepared to counter him. This is good.
There'll be time.
There'll be time. So thank you very much. I'm here to talk more about the direct middle market lending. Our type of assets are cash flow loans that really go to businesses going through transformation. By transformation, our predominant transformation is a private equity-backed leverage loan. That's really 90% of our client base is the private equity community. Embedded in that is we do CapEx, acquisition financing, and dividend, and call it generational control opportunities. The key themes for a middle market platform, I think it's a pretty vogue thing right now. Managers come in and out of middle market lending. If you look years ago, 10, 15 years ago, there was a lot of French and Japanese banks. They've gone away. Then there was a proliferation of CLOs, and CLO managers have consolidated. Now you have a rush of BDC and other unregulated FinCos who are taking in, where the regulated banks are getting pressure. So some of the themes I know this is an LP-centric audience, is that platform and managers actually matter. Not only should they matter to investors, but they actually matter to our private equity clients and the people we source business for. There are different strategies for investors who look to come into our asset class. There's levered and unlevered pools. There's actually liquid and illiquid pools, and we can go into that if people are interested in. I think one of the things you're going to hear from Andrew is this is a tough asset class, but if you look long term in middle market, I'll try to go through some statistics later, but it actually provides a premium over other fixed income assets, and the default rates are probably lower than people expected. So if you're building a diversified fixed income portfolio, middle market lending really has a place in people's processes. So I thought a good place to start is how we define, and we're Golub Capital, and probably some of our brethren define what middle market lending is, and those are businesses that are 10 to $75 million of EBITDA, and that different people will define it slightly lower, slightly larger. That's a good place. For direct, and I want to just stress direct versus others, direct lending asset arms, we originate our own assets. So differently than buying from a brokerage or an agent, my group and others like us go out and actually source our own opportunities, either through private equity funds, through lower tier banks, directly to companies themselves. And we establish a direct relationship with the borrowers and the stakeholders, and as I said earlier, predominantly private equity funds. We conduct our own due diligence, and that could last from weeks to months. And we negotiate our own terms and pricing. So differently than buying a prepackaged structure where you're kind of buying a bid and ask asset, every transaction we do is bespoke, and we work really hard to make it work. There's a pretty large opportunity set. About 33 to 40% of the U.S. GDP is middle market. So, selectivity when you're a credit manager is important, and we like this niche because there's a pretty large opportunity set. In middle market lending, you have lots of security choices. So some people are senior lenders, some people are junior lenders, some people who model themselves like Golub provide everything, including a one-stop. And we believe that taking all those attributes together really provides a premium for the liquidity and the complexity of what a middle market platform is. And I guess just some reasons why we think for you people it's attractive. Rates are for us they're pretty at all-time low. So we actually think there's more risk in rates rising than there is in rates going lower. And most of our probably 95% of our assets are floating rate. There are some LIBOR floors, so an increase in LIBOR, there will be some increase that we won't get the benefit of. But for the most part, there's once the floor is gone through, really every increase in LIBOR is a benefit. So we're actually going to do well, as opposed to take a hit on a fixed income asset or a fixed rate asset. The premium I spoke about earlier, I went back and looked at some of the statistics our team uses. It does narrow to as low as 20 sometimes when the markets get frothy, but many times our asset class is earning from 100 to 200 basis points premium to the liquid loan market or the high yield market, and we're senior and many of those assets are more junior oriented. And we have covenants, so high yield, when you look at a middle market loan, they're smaller companies, so they're more fragile. And, in many cases, people like to talk about default rates, but defaults aren't always bad. It just means sometimes you take a time out and you kind of reset strategy or figure out where it is. So we actually have pretty enhanced structures and covenants. That's a lot different than high yield or some of the broadly syndicated loans where there are a lot of covey light, which are essentially high yield loans without covenants. I looked at some of the statistics we had over the last 15 years. Middle market loans had an annual default rate of 3.2%, so it's kind of a long-term average. The commercial for Golub Capital we only have good statistics going back 10 years, but I think it kind of encompasses a couple of cycles, and ours is about 1%, so I like to think it's manager selectivity, and since I have a role in it, I like to think we do a good job. And there's the price volatility, there's lower correlation, because it's floating rate, because they don't really trade from an investor's perspective. Our assets, even though for GAAP we have to mark to market, there's not the same volatility for investors who have to deal with capital account balances and really their own books and how they monitor these loans. So just what makes a good middle market platform? Because there's a lot of them out there, and later on I'll just give a factor if I was selecting a manager, some of the things I'd look for. But credit discipline is number one, and everyone says that. But we really believe that discipline comes from choice. If you have a model that allows you to build an attractive platform, you have much more choice. You could say no. Many of our competitors just don't have the same choice and the breadth that we do. So sourcing matters. And earlier I said we were more private equity centric, and really we stay close to our borrowers too. So you want to win repeat business. For Golub, 75% of our transactions comes from firms we've worked with before, in many cases sometime in the same year. And that was true for 2014. And in 2014, actually 40% of our dollars deployed came from borrowers in our portfolio or borrowers who had been with us before. So really knowing and keeping your breadth and your funnel and the people who like you and building your sourcing. There's no such thing as proprietary deal flow. I just don't believe it. I don't even believe it in private equity or in venture. I believe there's proprietary ways about managing the deal flow that's available in the market, and that's really how we go to market. And there's only the other thing about just having a model from a lender's perspective, there only are a handful of deals that are capable of being a lead, and it's really a pretty big distinction because most of the market buys paper, right? They buy from someone else. At people like Golub, we sell paper to others, so we keep what we want for ourselves, and what we don't want or it's too big for our allocation model, we sell. And our client base will only select a handful of people to be a lead, and as a lead, you have more selectivity, you get more economics, and you get better returns because there's more fees and economics that go to being the lead. So being the lead in a credit platform versus, there are good people who buy CLO managers, but they're takers, where a direct lending model is more of a leader, and I think that's been a big distinction of how we've been very, very successful. And it's taken us 20 years to develop this. So it's not something you can just kind of raise some money and poof, you're the lead, and everybody now accepts you. There's a queuing. In credit, we have a view that it takes decades to build a reputation, it takes minutes to ruin it. So every firm develops a DNA, and ours has been developed over time. The other thing that's happened is there's a broad product offering. You just can't, nobody wants chocolate or vanilla anymore. It's kind of everybody wants flavors, so there's senior stretch, there's first out, last outs, there's one stops, there's second lien, there's mezzanine. So in a direct lending platform, clients just want to have the same thing any other manufacturing or business service want. They want supplier consolidation. And being able to offer your clients everything you can is important. So we work with small companies at the 10 million, large companies at the 75 million, and we can do a $30 million transaction and we can do a $400 million transaction for our clients. So we make it really easy for people to come back to us. And the other thing you really need to have is you have to have a team. Our team has been together for a really long time. So my business development team, the team that goes out and sources for us, we've been together for a really long time. The market knows that. The other thing is we tend to hire people who've been underwriters as opposed to people who are just good salespeople. So I like to think we have people who can do both. But when you go back to credit discipline, if my frontline people who are sourcing deals are better underwriters than my underwriters, my funnel is going to be a lot better. We have a credit process, an underwriting process that's been scalable. It's replicable over time. So there's a lot of infrastructure built to make sure that, right now we're doing about $5 billion of new commitments a year, and that's just our part of the balance sheet, not total transaction value. I have to make sure that the first deal and the last deal get done the same way. So having that discipline and having that scalability works. And from an infrastructure, the back office, the portfolio management, and the technology investments that takes today for a direct lending platform to work is pretty large. So the barriers to entry are pretty big. So just if I was and I'll go over. Some people say, where's a good place to invest? And if people have questions, I can tell you, why we're investing in software and not investing in energy. If we weren't investing in energy when energy was $100 and why. We can do that later for people if they're interested. But just taking this audience, if I was selecting a manager, if I was back in my New York Life days when I was making LP investments, I'd go through track record matters and attribution analysis matters. Who actually is the lead? But we make sure people have multiple cycles. There's a few people in the BDCs, you could do your homework. They were doing some pretty tough things in a few cycles, and the last one destroyed them. So two of them actually went down. One had to be absorbed, and one totally had to change their model. They got lucky in 2001. They didn't get lucky in 2007. So if you do things long, it will catch up to you. Understand the sourcing model. Are you dealing with a direct model? Or you're dealing with a buy desk, where people are buying paper more like a high yield desk. Product capabilities matter. Is it broad versus narrow? Are you buying someone who just does one part of the market? Are you buying someone who can do all parts of the market? And we think that helps us with risk return. Experience matters and industry expertise matter. Really look into the due diligence model, how replicable and scalable and consistent. How good are they at workouts? We do have companies that sometimes go bad, and we keep it out of his arena by working at it ourselves and fixing it. And we do a pretty good job saving because we have the circuit breakers to get us in there earlier. From an investor's perspective, do they have a strategy you want? Do you have issues with using leverage in your manager? So some of our people like our leverage, some don't like our leverage. Some people want liquidity, so they go into our BDC. Some people don't want liquidity, they go into our private funds. And then, what do you have an alignment of interest? We think our fees, our promote, our long-term versus short-term incentives. We have long-term incentives for our people and our investors and skin in the game. I would tell you, like Golub, I think we have over 10% of the money is from the principals that we invest. So every deal we do, people are writing checks. And that gets down to the senior vice president level. That's just not a partner level. Everyone knows that every deal we do affects their future. So, we have a pretty good alignment. So if done correctly, I would say, this is a great asset. You get an income stream immediately. We tend to give people a pretty fast J-curve there's no J-curve relative to private equity and venture. There's limited volatility, and in this market, I think we offer a pretty good hedge against inflation. So I can spend 15 minutes just on how we source deals. So anybody has any questions later, we can go through, but that's really an overview of direct lending, middle market cash flow lending model.
Great. Thanks, Andy. Appreciate that. One quick follow-up question. I look at your business, and I think it's truly filling the gap, and banks have left that business. Given what's happening in a lot of the investment banks and the shrinking revenue streams, whether it be as a result of a Volcker Rule and others, do you see the banks eventually coming back in to the disadvantage of firms like yourself?
For us, we use that $75 million line as kind of a bright line because we never really wanted to compete against them. So there are things, they have limits right now. They have the two big ones that are popular is the regulators don't want them to do a deal above 6 times leverage, and they want the projection models to show that they can repay at least half the loan in the first 5 years. And those are really the two things that get the most press. I think they're going to have to abandon where we are. So I think for us who want to be up to a $500 million facility, that's already a pressure because if you have to go head to head with the regulators, you want to make fees, right? They're a fee-driven business. So they're already starting to pull back from the lower end. And if they're going to take a challenge, they want $1 billion deal, right? There are some of them that believe that if a $300 million private equity fund can get more leverage than Blackstone, that ultimately there's going to be a reckoning, right? That sooner or later the LPs are going to look at this and say, why would I want to be in a levered fund that's in a smaller company than a larger company? I think they're delusional. I think ultimately I think more people will transfer out of the investment banks, or the investment banks will separate. I think like they'll go back to they were in the 70s or 80s where they were boutiques and they weren't part of commercial banks. I think that's just going to have to happen because the market's complaining too large. I wouldn't be surprised if Blackstone and KKR and others are just going to form them themselves to facilitate their own deals. I just think that 5 to 7 years ago, many of the arrangers never really went below 75. This is a new phenomenon. They came down because they were getting pressure to put paper out. So they're going to make, I'd love them to stop doing Covey Light because we do get pressure at our part of the market on that. So that's it. For us, it's a great opportunity. The market's great for us. This is probably a good 3 to 5 year run where we don't want, the fact that this is not going in the press is great. This is going to be a great run for us.
Right.
We were waiting for this for 2 years. I hired 2 people in the middle of last year, one from JP Morgan, one for Deutsche Bank, to move me up to hire to bigger clients. And it's happening faster for us than we thought it would. But it took longer than we thought for the regulators to kick in. They kicked in this year. They kind of, every institution in 2015 were going clean. We're not going so the regulatory environment right now is tough. And it's going to get tougher. It's getting tougher and tougher. So I think at some point they have to separate. I don't think they're going to loosen up. I think the people like UBS, they're going to figure out ways to create their own fincos. Goldman just did their own BDC. I think they're all trying to find unregulated ways, but that takes a long time. So I think for people like us, we have a good 3 to 5 year run, but I think those people, DNA is larger. They don't really want to be, we do middle market. When someone's a $15, $20 million EBITDA business, we're the only lender. We do a $100 million facility and we hold the whole thing. It's the private equity firm, it's us, it's over. That's a different model that the banks just never did. So, that's middle market. I think the BSL market, the CLO market, people buy liquid loans, I think they're in for a little bit of a transition. We have a group like that. But we're sourcing for them now. We're sourcing internally now.
Great. Thank you. All right. Andrew, you ready to
Say
trash Andy?
No, I'm not going to.
You could say that we are the only good manager you've never bought from.
I won't bash Andy's firm. It's a great firm. I would comment on a few things though. So I'm going to start high level. I talk a little bit. I do want to comment on a couple of things Andy said. I want to talk about the regulatory environment, which he touched on, and what that is driving the banks to do, what we see the direct lenders doing, and then where we can talk about some specifics out there as how this is all kind of coming together. So just 2 seconds on what we do. So we are secondary purchasers of secured loans. Right. By and large, we are sourcing directly from original lenders, middle market lenders all over the country. Think of banks like Comerica or Union Bank of California or Amegy Bank or SunTrust on the higher end. Guys who are regional players who are doing loans sort of up to businesses up to $500 million of total enterprise value. They will, as Andy mentioned, tend to put those into the hands of, call it 12 to 18 lenders. And, sometimes those loans go bad or the company underperforms. In the middle market world, so from a regulatory perspective, there's 2 speeds, right? So there's JP Morgan and Bank of America who can do whatever they want, and then there is everybody else who has to follow the rules. And the everybody else who has to follow the rules, part of that rule environment is they have to have covenants and the companies have to perform to them. As Andy mentioned, the regulatory 2 years ago, the government published what they call the updated guidance on leverage lending. So those is the OCC, FDIC, and Federal Reserve, which are the 3 primary regulators that oversee the banking industry. In 1998, they started publishing a series of guidances on leverage lending, which the banking community looks back on and says, okay, that was the starting gun for the boom in leverage lending, because the regulators at that point said essentially, all right, boys, turn the engines on, let's get this thing moving. They allowed for higher levels of leverage. They allowed for looser covenant packages, et cetera. The guidance that was published 2 years ago went into comments the year before that, and as Andy said, has been rolled out over the past 12 months, is the exact opposite of that. It hard caps leverage at 6.5 times. It demands pay downs, it demands covenants, and says if you have a problem credit, we'll give you sort of a very short window to get right, but then we need you to exit it, because we want you to look at your loan portfolios as portfolios. Stop thinking of yourself as relationships with the borrowers. You don't owe a duty to them, you owe a duty to the folks you're essentially managing money on behalf of, your depositors, and we want you to protect their money in their portfolio of assets. So what's that? The consequence of that is twofold. Number one, you are seeing banks look at credits, both new credits and credits in their portfolio, because the way the rule works is the moment you have to change a comma in your credit agreement, you're subject to the new rule. So the legacy portfolio can exist, but any change falls under the new rule. So they're looking at their existing portfolios, and any time there's a problem, they essentially have to exit the position. So these rules are administered by the regional Fed presidents, and so there is variability in how they're administered, Fed region to Fed region. So for instance, New York is very aggressive about cleaning up the books of its banks. There has never been a bad loan ever in Texas. And so we've been a beneficiary of the banks disposing of assets, and of course, I don't see that guidance changing anytime soon. So I think there'll be what we've seen banks do now is sort of transition to regular portfolio review and disposals. It tends to be around the quarters, no surprise. It is highly motivated by banks go through several regulatory issues every year, sort of regulatory reviews, the most significant of which, from our perspective, is what's known as the SNC review, the Shared National Credit Review, which is where a bank examiner comes in and looks line by line at your portfolio and says this is a past credit or a failed credit or a special mention credit or a special asset, et cetera, all these euphemisms for not going to pay their bills. And you either you have a few choices. You can either offset credit against it, or offset capital against it, or dispose of it. Now, for banks, they lend at LIBOR 250. So the moment, and they probably, if you think about where their deposits are and where they're borrowing their own money and where their cost of equity is, I don't know, they're probably weighted average cost of capital around LIBOR 250, which means that they only make money on leverage. And so the moment you have to offset capital against it, well, they've necessarily turned that asset into a non-earner or maybe even a negative contributor to their cash flows, which economically incentivizes them to get out of loans. So we've been a beneficiary of that transition. The second thing is obviously that it has pushed more borrowers into the unregulated space. So now let's think about that for a second. Banks make a loan with a zero expectation of loss, right? Like their risk tolerance approximates zero, right? So the cost of a zero loss is LIBOR 250 to the borrower, right? That's the cost of low risk credit. Now, when an unregulated lender is making a 9 or 10% loan, what does that tell you about their expectation of loss, right? It's higher. It's meaningfully higher. And there is a continuum of capital available from LIBOR 250 to 9 or 10%. And so the risk that the direct lenders have to address is that are they making loans to people who are fundamentally less creditworthy and therefore willing to pay 4 times more the cost of capital than a good borrower is willing to pay or should have to pay. And that's a challenge that I think we are sort of at the front end of understanding. There's been a big swell of liquidity into the direct lending market. And what we see is when LPs are going to look at direct lenders, don't think of yourselves as LPs. Don't think of yourselves as investors. You are bank examiners, right? You are doing the same thing a bank examiner does when he or she looks at a bank, because these people are stepping into the role of the bank. So are they making loans to companies that they shouldn't? Well, 6.5 times leverage. I don't know, that seems like a high total enterprise value for a lot of these borrowers. I mean, the government doesn't want banks to make 6.5 times loans. Guess what? You shouldn't want people to make 6.5 times loans either, right? Those will fail, right? Those will default. The government wants people to be able to repay the money they borrow. Guess what? LPs should want that too, right? So I think as you're thinking about looking at these things, I think there's serious questions that have to be asked about what are the quality of these loans that are being made. Now, for me, it's fantastic. They should make all these loans that they can, right? This is my manufacturing division. We're going to be in high cotton for a while. Because we are already seeing it. As I mentioned, the swell of liquidity has come into the market. There's been a rapid deployment of capital to a lot of borrowers who are probably not credit worthy. They're doing it at all-time low rates. They're doing it into borrowers who may or may not have a borrowing history. And they're doing it, the real numbers, forget the pro formas, because that's not how banks think about loans. It has to be on what are the real numbers. The real numbers say that the big chunk of these loans are at best BB- equivalent, more likely CCCs. So the CCC mortality rate for all eternity, from the time of Attila the Hun, there is a 3-year mortality rate to CCCs, a 30% mortality rate, right? It is just a truism for all of history that when you make loans to bad companies, the loans go bad, right? Not all of them, but a big chunk of them. And so I think that we are at the front end of deploying a lot of capital, and it will take some time to see those things come out. Frankly, they're coming faster than we would have expected. The bad loans we expected them to be, a year or two from now. We're seeing those come already. And, for us, look, the reality is Andy's right. There are people who are making, structurally better loans than other folks. So, we're very focused, we're laser focused on documents because we drive value through process. So I'm not trying to, as a manager, trying to pick sectors or I think this is going to expand in multiple or this is that. What we look at is we say we buy assets that we can get at a discount to what we believe intrinsic value is, and then utilize the rights, remedies, obligations afforded us under those documents to effectuate an accretion of value to our part of the capital structure and ultimately an exit from the situation. We will step into the shoes of lenders where they have a troubled borrower that for a lot of reasons they may or may not be able to bank. For instance, you may have caught, didn't get a ton of press outside the distress community. We just stepped into the shoes of Wells Fargo in Colt Defense, the gun manufacturer here in Connecticut. Now that's a challenging sector because it's defense, it's guns, which I am patently not a fan of guns on a personal basis, but it is a special mention credit. It is going to have to address the leverage on its balance sheet at some time, and that was just more than a bank could handle. So we deal with process-oriented, most often restructuring-oriented borrowers that are facing real problems. Our capital allows them to transition from their original lending original lenders into a more stable form, often at a lower valuation, and then find a longer-term home, either as a whole or in pieces, or we try and look at a company and say, what, blank sheet of paper, what should this look like, and we try to get it there. So now, I would also say, as a consequence of being process-oriented, there are some things that we are laser focused on with respect to the direct lending community. So they have this balderdash called an agreement amongst lenders that they do behind the scenes. So they go tell a borrower that we're going to lend you 9% money, and they call it a unitranche, which is a fancy name for we're gonna slice it up behind the scenes and essentially lever our own return. So they'll go to the lender or the borrower with one loan. They'll pay 8-9%, and then behind the scenes they'll go slice that loan up and sell off the top piece at a very low rate to somebody who will accept that, and then the next piece at a higher rate to somebody who will accept that, and then keep the bottom end for themselves at a much higher rate, which is what then forces up their returns. So now let's put that into a restructuring context. Well, that is there are direct lenders who will assert to you that is an agreement amongst lenders outside the purview of the bankruptcy court. So, having spent a reasonably large amount of time inside a bankruptcy court, it would be my assertion to you that is an untested theory, and that once we get a real doozy of a restructuring, as the direct lenders go into larger deals with more stakeholders, more unsecured creditors, more union issues, OPEB issues, all of those things where all the nooks and crannies tend to get explored through the court-sanctioned restructuring process. I think these agreement amongst lenders are going to come under real pressure, and I think there is a threat to the LP's ultimate interest in these as they are challenged, which I expect will happen. We haven't really seen it in any significant way yet, but I do believe that'll come. So I've given you a lot of what ifs and where is all this happening? Well, it is, I'm originally from Texas, and so people will say, do you know anything about oil and gas? So, yeah, it's in my blood, literally in my blood. I grew up in Southeast Texas around the refining business. And, there's a credit apocalypse going on in Texas at the moment, right? It is as bad as you can imagine. So we've been spending a fair amount of time there talking to banks, direct lenders, everybody who's, insurance companies, everybody who's providing credit, has been providing credit there. The banks are essentially under the desk at the moment, hoping for a recovery in prices. They have a lot of levers to pull. There's a perverse thing in that the more highly leveraged you were, the more your bank forced you to hedge, which is what their regulators require them to force their borrowers to do. And so you're running through those now. Come summertime, people coming back headed back towards school. They're going to be staring down third quarter borrowing-based redeterminations on their ABLs, realizing the hedges are running off. Their price decks in the loans are 110% of the strip when the regulator wants them to be at 60, and it's going to be as Robert Louis Stevenson said, sooner or later, everyone sits down to a banquet of consequences. And that is going to be that moment. Right now, you're already the borrowers who are already going into bankruptcy are the ones that are funded by unregulated money. Because there is less flexibility, they generally have worse credit underwriting, and most don't have any real workout experience or skill internally. And so those are very quickly moving to troubled situations. The bigger companies that are funded by the banks, that'll be third quarter. But we are seeing the unregulated borrowers file first. Now, I just want to say one last thing, which is, so where else, can we think about how the government has dealt with unregulated lending? So in 2005, there was a rewrite of the bankruptcy code, made lending to consumers much more favorable to the lender than the consumer, and consumers sought credit elsewhere. And so you had a massive swell in liquidity in the payday lending space, providing credit to consumers who were not able to be banked by the traditional sources of capital. Sounds weirdly familiar to what we're talking about. So it took a couple of years, but this morning, actually, the government published guidelines on payday lending, where they are now going to regulate the previously unregulated industry. It seems to me that if there is a large swell of liquidity providing capital to American business, sooner or later, it stands to reason the government will get interested in how these loans are being made and what does it mean for borrowers, and this sector will be regulated, as, by the way, it likely should be. So, well, should I break there?
That's it. Great break.
Okay.
Great. Thank you. And
I didn't say anything bad about it.
I know. And I know Andy.
I would just say we don't tranche up our one-stops like you described. We hold them all.
Right. I know that Andy has some things he probably wants to
That's okay. I'm happy to
go back to. But we're going to go and we're going to move straight to Bob Conrads, who is the one peer-to-peer lender on the panel. And I'll let you take it away, Bob.
Thanks. So, as has been mentioned, I'm going to be talking about the consumer sector and not the payday end of it, but the near prime all the way through super prime business. And this is, unlike the other direct lending businesses that I think most of you are familiar with, is in fact a new industry segment that started to evolve back in the 2006-07 timeframe, when the two leaders in the industry, Prosper Marketplace and Lending Club, both located in San Francisco, got started, and their vision initially was to provide the eBay platform for financial services. So the idea was that just as you can list your stereo receiver on eBay, you should be able to list a loan if you're a consumer asking for a loan, and have your peers fund that loan. And the two companies instituted platforms, the technology to enable that, and they operated under a California corporate banking exemption, whereby they sliced these loans up to as little as $25. So picture loan sizes from $1,000 to $35,000, where somebody could make an application and with very little underwriting and virtually no verification, have that loan posted, and other consumers open up an investment account and buy as little as $25 slices of that loan with very little information on that consumer, and certainly no data to perform credit analysis. Well, as you might imagine, that didn't turn out very well. So, it turns out it takes these loans about 14 or 15 months in a monthly vintage, to get to their maximum default rates. You can imagine you give somebody $15,000 and they are going to spend it over the period of a year and pay their installment. These are all fully amortizing loans until they run out of money. So you really don't see your default frequencies get shaped for about 12 to 14 months. So as you think about the timeline here, in 2008, lenders started losing money, and complaints went to the SEC. And the SEC stepped in and said, you know what? You're actually originating securities, and you have to stop doing that and register with us and register these securities. So both companies went through a period of modified shutdown while they got registered with the SEC, and also got the technology up and running where they could register each and every loan that was listed. And the SEC, through their process, made the companies improve their underwriting and institute verification processes to reduce or eliminate fraud. And that whole process took a couple of years. And so by the end of 2010, the companies had themselves organized, more or less, and got onto the business model that they're on today, which is a screening model, an underwriting model, a verification model, and then offering those loans up to the public, quote unquote. And that is regulated by the SEC as well. So as they went through early parts of late 2010, early parts of 2011, what they found was it was very difficult to go out and find investors, consumers, convince them to take $5,000 or $10,000 out of their savings account and put it into an investment account, and also at the same time find the right number of borrowers that are going to have the right characteristics that these unknown lenders are going to be attracted to, and put that together. So both companies struggled for quite a while trying to scale their businesses. And Lending Club wisely came up with the idea that what they would rather have is people that have $100,000 or $200,000 or $300,000 investing in these loans, because they're much easier to service, find and service. And the problem with that is that people who can afford to invest several $100,000 in these types of loans don't want to sit behind a tube picking loans all day, because it's not only getting your initial capital invested, it's also reinvesting the principal and interest that comes off of the portfolio every month. So they started their own, Lending Club started their own limited partnership called Lending Club Advisors, which aggregated capital and provided a more consistent source of capital so they could find borrowers. But even that wasn't enough. So that's where we sort of got started in this. We were introduced to the companies in the early part of 2011, and after doing our diligence and understanding sort of how we thought this asset class might evolve, got interested in engaging in the process. Now, as I've described, the industry had evolved, and so you might ask, well, why does this opportunity, or at that time even, why did that opportunity exist and be attractive to somebody who wanted to put large amounts of capital to work? And the reason is because what has happened to the credit card industry and the banking industry over the last 6 or 7 years. So the opportunity here with this near prime and prime consumer lending is all driven by the Credit Card Act and the Dodd-Frank implementation in Basel III. So the regulatory capital requirements that have been mentioned before, and in this case, the Dodd-Frank regulations, which have much more stringent underwriting requirements for consumers, read costly for the banks. It costs the bank about 700 basis points to originate one of these consumer loans. Well, even if you're a good customer of a Bank of America customer, and you have a few $1,000s in your checking account and a few $1,000s in your savings account, and you make $80,000 or $100,000 a year, and you're a good credit, 720, 730 credit, Bank of America is not going to make you a $5,000 or $10,000 loan. It's just too expensive. So that is the vacuum that the banks created. The credit card companies, through the Card Act of 2009, unintended consequence was that prime consumers were priced up by 200 to 300 basis points in their revolving credit, and subprime was priced down by 200 or 300 basis points. So here you have prime consumers subsidizing subprime consumers. And that was an unintended consequence, but it's real, it's there, and it's large, to the tune of about $700 or $800 billion. And the other thing that we all have to recognize is that most Americans revolve their credit card debt. I mean, I think everybody in this room probably uses it as an accounting mechanism and pays it off every month, but the vast majority of people in the United States revolve their debt. And surprisingly, even in this zero interest rate environment, the average credit card debt for a prime consumer costs about 17%. So it's a costly mechanism, and there's no place else to go. There's no beneficial finance, household finance, money store anymore. So this void is what attracted Lending Club and Prosper, and then the struggle that they had was to scale. So we were the first institution that came to the table with consistent flow of capital. But when we came in, our ground rules were that we wanted to be able to underwrite the loans ourselves. So after the companies screen out the borrowers, do their underwriting, size the loan, price the loan, and list the loan, our requirement was we want all that data so that we can re-underwrite the borrower and cherry pick to a targeted return net of fees, expenses, and expected charge-offs of about 9 to 9.5%. And that was the way we entered the industry. In 2013, first quarter 2013, institutional capital discovered this asset class. And there's been a flood of capital, like it's been mentioned on the panel here this morning, coming into this asset class. And the companies are struggling to keep up with the demand and find the borrowers that they can process properly to offer those up to the investors. And as also what's happened in the course of the last 18 to 20 months is you don't have just two platforms anymore. There's about 180 out there now, and they're multiplying like rabbits. So we try to track all of them. We invest on the top three in the industry, Prosper, Lending Club, and now a new lender, Marlette Funding Corporation, which aims at a little bit higher credit borrower than Prosper and Lending Club. So a Prosper Lending Club portfolio would typically be FICO scores in the 690 to 700. Marlette is closer to 715 to 720. And those three companies in total are originating about $700 million a month. Now, that's in the third month of 2015. In the third month of 2011, the entire industry originations were less than $20 million. So there's been a huge growth here. And whenever you have that rapid a growth, there's all kinds of bad things that can happen. And it all relates to credit. So any of you who have followed the Lending Club IPO, which occurred in December of last year, now is, I think, valued somewhere around $8 billion, and had quite a run and a lot of publicity around it. And then a small business lender that came out shortly after that, On Deck. There's been a lot of press around the growth in this industry and can it continue, and how has the industry changed. And a couple of main things to recognize is that now the platforms have recognized that allowing this cherry picking that we do results in adverse selection for parts of the platforms. It's very difficult to manage. So the industry has moved to just raw allocations across the platform, and not providing as much data as they used to. So it's gone from a mantra of more transparency to more opacity. And that's a challenge for us and for other folks that buy these loans to maintain that integrity and transparency so that we can do our credit work. Because at the end of the day, this is not a technology play, which it's sort of been positioned by Wall Street. It's credit. It's all about credit. And when you go to these industry conferences, there's one big one, Lend It, which now has attracts over 1,000 people to it. You can count the number of people that have consumer credit experience on one hand. They're technologists. Everybody thinks if they throw up a website and can process loans that they're going to participate in this wave. So things to really be cognizant of as a lender and ultimately as an investor, an LP in a fund, is what kind of credit work can that fund do? What's the experience, not just the raw experience of the people, but the access to data and the credit across the industry. And I think that's one thing we're unique in, that we have more data on the loans than anybody else can have, because one, we were there first, so we're collecting data from all the platforms from the get-go, and we have that archive. So every time that one of the companies changes a credit policy, we can go back and retro score all the borrowers from the beginning to see how they would perform under the new credit policy and how that pricing should be adjusted. And that gives us an enormous advantage in just being able to buy correctly, because as I mentioned earlier, you don't really know what you've bought unless you're doing your own credit work for about a year. And it's been, I think, a bit surprising to some investors that got started early on and are finding that their returns are not quite what they thought they were going to be, because they don't understand exactly what they're buying. And consumer credit today is very robust, or it can be. Credit analysis can be very robust because of all the data that's available on the consumer today. But you've got to have the experience and the models in order to be able to implement selections and then to manage those going forward. So the real challenge here, I think, as this industry evolves, is going to be to be selective in working with the platforms to make sure that they're doing proper credit work and they have good reporting and tracking, and watch them as they move into new business segments. Lending Club, for example, is moving from consumer to small business. They're also talking about potentially a mortgage product. So having that focus and control, is going to be extremely important as this industry evolves.
Great, thank you. One follow-up question for you, Bob. Yours is a relatively new asset, which hasn't been through tough cycles yet. How do you get comfortable with consumer lending, unsecured consumer lending, and I guess sort of dovetailing into what do you see are the greatest risks? Right.
So it actually isn't a new asset. It's a new way of delivering consumer credit. 90%-ish, so to speak, of these loans are used to pay down this high-cost credit card debt, because the consumers can save 300 to 400 basis points on their on the cost of their revolving credit, and that assumes that they haven't tripped a wire that kicks them up into a 30% range. And so you can go back through time and look at performance of unsecured consumer credit through credit cards and also installment lending over a long period of time to develop your expected default curves for different cohorts of credit through the cycles. And so we've one of the things that we focused on is doing a sensitivity analysis on the portfolio and the kind of loans that we buy to determine how bad things could get if you went through another liquidity crisis like we had in the 2009 timeframe, where charge-offs peaked in the credit card industry around 11%. They're now down around 4%. Our portfolio is running a little shy of 6% defaults. So in order to have your first dollar of capital impaired in the kind of loan selection we do, you'd have to have a charge-off rate of about 16% over 2 years, which would be the equivalent of somewhere in an unemployment shock area of somewhere in the 15 to 20% range. So the biggest risk with this asset class is unemployment shock. It's not the structural unemployment, because people that don't have jobs don't get these loans. But if somebody doesn't have a job, their bank account is going to run out of cash, and these are by and large ACH transactions, automatic clearinghouse transactions. So when somebody gets a loan, the partner bank distributes that capital to the bank account, the individual's bank account, with an ACH transaction, and then every month that bank account is debited the $400 or so payment, and as long as there's cash in that bank account, you're going to probably get paid. But guy loses his job, eventually he's going to run out of cash in that account, and you're not going to get paid. So that that kind of analysis and that understanding, and it's not just credit scoring, but it's also using discrete criteria that are developed around what consumer behavior is like in stressed situations, and that goes beyond just a credit scorecard. It's combining various discrete criteria: loan size versus debt to income, the track record or the trend in somebody's overall debt to income over time and through crises, and you can get data on all of that these days. So it's by deep analysis. In the case of Marlette, the company uses roughly 1,600 variables on each consumer. In the case of Prosper and Lending Club, it's between 250 and 450. We use all of those variables to re-underwrite the borrower, and that can be done in a matter of milliseconds today. So this whole model of branch banking, loan officers, developing relationships, it's all been disintermediated by technology and data.
Great, thanks. Before we open up for questions, and if no one has, I have some follow-up. I wanted to give the panelists a chance to, if they have any questions for each other or any.
I do actually for
right.
Bob. So if you were unable to direct access the bank account, would that change your underwriting and pricing? Because you're not making an unsecured loan, but you do essentially have a security interest in their bank account. And I'm asking a leading question because the CFPB rules that were published this morning are forbidding now people from taking a beneficial interest in bank accounts.
Yeah. So it's it does change the dynamic on the underwriting, but the consumer elects it. So it's not imposed, it's an election.
But I think they're saying you can't do it anymore.
No ACH transactions.
It's look, all we have is the summary rules published this morning. So, yeah. But it's if you're unable to take a security interest, it seems that should change your pricing.
Well, first of all, it's not a security interest; it's a payment.
Right, but in credit underwriting terms, I'm thinking of it as the moment you can essentially sweep cash.
Right.
So, if you can't do that, what does that do? I mean, what's your collectability look like if you couldn't do that, and how does that impact your pricing?
Well, the reference point there is credit card data, because the credit card companies disincent people from using ACH because they want them to trip the payment, right, to kick them up.
Right.
So there's a fair amount of data on how many people, what the default rate is in different credit cohorts within the credit card spectrum. Mm-hmm. So it will change the pricing, but it's a data set that can be accessed to evaluate and to adjust.
And then,
but also to be clear, this is not an auction process. Mm-hmm. So the only decision, we don't set pricing. The pricing is set by the platform companies, and our decision is whether we want to buy the loan or not. So the loan amount is fixed, and the interest rate is fixed, and our decision is whether we want to buy that loan or not.
And then sort of a second question that maybe goes to the other way on value is, given the transparency you have, are you able to, I don't know if you have enough data yet to say this, but are you able to sell charge-offs at a higher rate than otherwise might be available because of the level of information you have?
No. First of all, we, the fund, do not get involved in collections at all. So we don't.
But you're selling the charge-off, right?
We do not. That is done by the platform company. So the loans end up in bankruptcy remote trusts that are serviced by the platform companies. In the event that the platform companies can't service the loans, then a backup servicer comes in to take care of that. And those loans, the typical recovery rate on those loans is about 5%. So we're experiencing charge-off rates a little less than 6%. Recovery is 5%, so it's a de minimis part of the economics of the fund. So the whole game that has to be played is to select good borrowers at the front end. It's not to try to improve collections on the back end.
Great, thank you. You know, I have one question, probably more for Andy or Andrew. From through the LP's lens, you know, maybe sort of level set some expectations for your strategies for the return profile as we go through market environments of turbulence, crisis, euphoria. You know, what should folks expect?
I mean, I'll say, I thought I took it. I was taking things that we had this morning. I think for us, I had a slide, of course, I probably left it at home. I ripped out of our pitch book that I think from a unlevered perspective, long term, I think we've had a pretty consistent return where it's been in the low 6s to the high 7s, going near 8, give or year. With the levered funds, you know, we're usually, you know, as 9 being the lowest, but up to 12%, you know, 13%, depending on the vintage year and depending on where the, you know, LIBOR is, depending on where rates are. So it's been pretty consistent that if you looked at all of our funds and the inception to date, they all pretty much cluster. I mean, clearly in the downturn years, we didn't perform as well as, you know, when credit was tight and pricing was higher and defaults were lower. You know, this kind of a little cycle, but you know, those returns are pretty consistent going back. I mean, we have returns going back to 1994. We were a little bit more junior capital back then, but our return profile has blips, but it's pretty consistent. So I would say, as long as there's nothing that impacts us that we don't do to ourselves, so as long as we can get leverage, as long as the vehicles we use, as long as the products we offer are still accepted, I would expect that would continue. If LIBOR went up, that would be actually good for us, you know, because we would earn more rate. So you know, that wouldn't be too bad. If spreads went up, that would be great. You know, I would say, you know, compared to this downside, if we are pretty much, I think we are in a, you know, the credit is a little bit looser than it was, but I think the EBITDA embedded in all the companies today is less frothy than 2007. I think it's a more conservative EBITDA profile. The leverage, you know, I know one of the things Andrew said before was, you know, we're doing things that's unnatural, but I would argue if you went back to late 1980s, you went back to, you know, 1999, you went back to 2007, these same dynamics existed back then. So I don't think I actually think there's parts of this cycle that actually is more conservative than where we were the last time. And you know, our loans tend to be, we shadow rate or get ratings on everything. They tend to be in the B+B range, not triple C. So you know, if it's triple C, we've done something wrong. And that usually happens. So I would expect that continue if we stay within that mantra.
Great, thank you.
So our return profile, we're unleveraged. We've never used leverage in the fund. So we aim for a gross underwriting of 15%, so that nets our investors 10 to 12. Last year we were 10.25 net to investors, and over the life of the fund we are 14.5 net to investors. And we've been in business 6 years, 7 years.
Great.
So our returns have been running in the 9 to 9.5% range for the last 4 years, with no monthly volatility. The portfolio has about 150,000 loans in it. Average loan size is about $10,000, $11,000 spread across the United States. So highly diversified. These consumers are employed by different industries. Prime, average credit score in the low 700s. And we do use a little bit of leverage. We introduced leverage last year about this time, and we run about 24% leverage on the fund.
Great, thanks. Well, let's open it up to the room. Any questions? Go ahead.
I guess I didn't realize the extent to which, I knew that Dodd-Frank and Basel III and both these were restraining things. I guess I didn't realize the extent to which it was really penalizing small business and consumers, particularly credit-related consumers. I read something earlier this week that suggested, I don't recall if it was the SEC, the Fed, or SIFMA, is starting to nose around in terms of extending some of the tenets of those rules to the so-called shadow banking industry. Do you think that's real? And if so, how long do you think it could take for that to play out?
That doesn't impact us. That's Bob, is that more you on the consumer?
Yeah, I think that all the regulatory regimes that have been instituted as a result of what you're describing have increased the cost and forced the banks to reevaluate and, in most cases, get out of the business because of the costs associated with it. Even though they want to hold the paper. In fact, today the banks are buying paper from these platform companies, but to originate the paper is just too costly and politically too volatile for them to deal with. And I think because of that, I don't think that banks will come back into this segment like a lot of people are fearing or have hypothesized that if these platform companies get to be too large and regulators do focus on them, that they'll be disadvantaged and then banks will step back in. I think that's going to be a long time in coming.
But I guess my real question, I mean, you didn't perhaps phrase it well, was that if the regulators do start coming in that direction, do they realize that they're really sort of turning off the spigot on something that's very critical from the standpoint of the functioning of the economy? That's capitalism.
Well, yeah, but that's never stopped a regulator.
There's regulatory dissidence on this. So if you look, and you can find this in the Federal Reserve's white paper series. So the Federal Reserve is very conscious of the fact that there are that the unregulated lending community across corporate and consumer serves a vital role providing credit to those who might otherwise not be able to access it. The Federal Reserve and largely the OCC, these are the two people you need to be really focused on, are traditionally generally non-political. The CFPB, if you read their charter, it is actually sort of scary broad. And theoretically, they could assert regulatory standards on essentially any lender, whether they touch a consumer ultimately or not. And so I think people are I think you hear a lot in Congress about the CFPB for that reason. And that is, I think people understand that to be a more fundamentally political organization within the government, and they clearly have an agenda. So there is there is a sort of two-minded approach in government right now.
Yeah, the FDIC, the one thing I did not mention in the commentary is that these platform companies do not actually originate the loans. They work with partner banks that are FDIC regulated. And there are only 3 really now that are operable, but they all have gotten the explicit blessing in their business plan review by the examiners to engage in the so-called peer-to-peer or marketplace lending to support that. But I think, as Andrew points out, the real issue on the regulatory front today is the CFPB, and it is. I use the word scary. I would concur with that. You just never know where they're going.
Right, Bill.
Yeah, I just had a question. It was interesting to hear on the secured lending or first lien side, the 20-year average pricing is call it 6 or 7%, or maybe that's not pricing, but that's the return. And then when you look at the consumer, which is instead of being first lien, it's really last lien. I mean, it's probably the first loan that the person defaults on, as opposed to their house or maybe their car. And that, I could see why an individual would want to trade a 17% for 8 or 9 or 10. That makes sense. But what's the right underwriting price for that loan? It's sort of more of a mezz, I don't know what you want to call it, but it's an unsecured loan in someone's cap structure. Clearly, they have the cash. Most people would pay off their credit card. And they don't, or they have some other uses of it. So forget what the market is now pricing that at. What is the sort of the fundamental underwriting where, these guys have been doing, we do 20 years of underwriting personal loan. You have a view of what you'll do and what you're underwriting if the pricing is not there to do it. Is there a price under which you don't think this makes any sense? If it's tighter?
Well, it depends upon the cohort, because if you're lending to a subprime borrower, for example, you're not going to be satisfied with anything less than 36 percent or 30 to 36%, and you're expecting a default rate in the 12%, 13% range, whereas if you're underwriting to a borrower that has nominally a 740 or 750 FICO score and is going to be charged a 7% rate, you're underwriting to a 1 to 2.5% default rate. So it just varies by cohort, and that's where the pricing comes in. And then where the discrete criteria comes in is how borrowers in those different cohorts perform under economically stressed situations. And in order to get a handle on that, you've got to look at each individual borrower and what their history is. So one of the things we don't invest in, for example, is what we call thin files, somebody that doesn't have a robust credit history over a fairly long period of time, 10, 12, 13 years. There's a lot of that that's processed by the platform companies, but that gets kicked out in our underwriting process. So it's a multifaceted approach to the underwriting at different risk levels.
Great.
Two questions. One is for Bob, and the other one is for the two, Andrew and Andy. The question on the pure lending is like with so many 180 saying platform going on in this space, what kind of pricing you have seen that come down, and also for the returns and over the last 3, 4 years, and for investors in this space, what do you think the time frame in the next is that maybe 3, 4 years, additional years that we can get decent returns, and then the credit cycle could change and the default picks up and the return will diminish.
Correct. So a couple of comments. First of all, on the 180 platform companies, the vast majority of them don't get any traction at all, and they'll fold the tent and go away, or it'll take them a long time before they get the traction. But the real pressure on rates and on returns comes from the capital side. And we've seen, since we got started in 2011, sort of across the spectrum, about a 250 basis point deterioration in returns. So we've mitigated that by tighter loan selection. So our participation on the platforms in the early days, Prosper and Lending Club, we ranged anywhere between 20 and 40% of their volumes in the early days. We're now down in the low teens, low to mid-teens as a percent of their volumes as they've grown and they've expanded their footprint across the credit spectrum. And then we've added leverage in order to mitigate that price decrease as well. So how far it goes and how long it takes to get there is, I'm not clairvoyant, but I would think that, spreads will continue to come in, but at some point investors will stop as well, because there is an added risk associated with this asset class that you got to get paid for. And I don't know if it's 3 or 5 or 10 years.
My question for Andrew and Andy is we have seen a lot of the distressed funds raised in the past 2 years, and I'm wondering how much impact or changes the dynamics in your investing.
Yeah, for us, it hasn't really impacted. So, we pursue, workout. I mean, we're essentially like old school outsourced workout for banks. Most of the large funds that you see raising capital are pursuing, purchases of, unsecured debt, trying to create a fulcrum security, claim the equity of the company. It's a very different way of approaching distressed investing. For us, we almost try and turn it into a manufacturing process. Buy, restructure, exit. Wash, rinse, repeat. Because we are participating in smaller cap structures, the 80% of our portfolio is in companies that have under $500 million of total enterprise value. That's a pretty narrow field, and because they are very technical, process-driven workouts, It's a somewhat specialized skill set that it's sort of hard to show up one day and start doing. The distress business is very much a apprenticeship business, and so I have two partners, one of whom's been in the business about as long as I have, was at Bear Stearns. He focuses really on the front-end sourcing for us, so he's out talking to banks and insurance companies and finance companies and unregulated lenders all day. And I focus on the research and restructuring side of things. We have a third partner who named Henry Miller, who founded a firm called Miller Buckfire. We had to fill out a DDQ recently. When was your first day in the distress business? Mine was mid-90s, Paul's was mid-90s, and Henry's was October 12th, 1968. And so, we have a lot of restructuring experience in the office, because at the end of the day, you're looking for your problem solvers first and foremost. We are very much a corporate finance strategy rather than some kind of trading strategy. So when you see Howard Marks and Mark Lazary and all these guys raising $10 billion at a time, they're looking to buy the latest KKR mistake instead of where we're headed.
And it doesn't really impact us. That doesn't really impact our model. Our underwriting is driven that if we make a loan, we have to, if something goes wrong, would we want to own the company at the entry point we're making the loan? So that's why it's very important for us to be the lead, to be in some case the sole lender. Intro lender issues are complicated. Sole lender issues are not. So many of our times when we're the sole, or we like smaller groups of lenders, we like more clubs than distributed loans, where you can create crisis that he could benefit from, where some people's tolerances change. So we're prepared to take over any business that doesn't perform, run it, fix it, and move it out ourselves. So we're likely not to be selling it off. I don't believe, since I've been here in 11 years, we've not sold a loan to a distress fund that we've been part of. So we've there's a saying: you make it, you break it, you fix it, right? So that's kind of our mentality, and that shows up in our long-term returns. In that there are times that we can recover back out just with some patience, right?
Yeah, great. I think we're good.
Yeah.
Thank you very much.
Yeah. Thanks, Jeff. Okay, so a couple things.
Nice to meet you.
We're not done yet.
Oh, sorry. They were all saying goodbye.
I'm sorry. Connie, May 21st, we're meeting back here in the room. Okay, under the topic of terms and conditions, the 1,000-pound elephant in the room. So we've got three very, very, very outspoken limited partners here to talk about some of the fees and terms that are banning about the industry. So it ought to be interesting. I want to say just about some of these exhibitions that are here. One of our members, Prince Max from Liechtenstein Global Trust, has an exhibition of Northern Baroque splendor in the next room. If you haven't seen it, you ought to. It's been sitting in Vienna for years, gathering dust, and Peter Sutton has a relationship with the Prince, brought it here. It's the first time it's showing in the U.S. It's fantastic. So if you can, take a look. Finally, I really want to thank Kurt Schacht, Lawrence Russian, and Jeff for putting together this panel. Very diverse. Thank you, gentlemen. And finally, Connie, again, our gracious Sergeant-at-Arms, Connie Hauschnecht. When is our prospective member reception? Wednesday, May 6th. Again, if you have any colleagues that would like to become a member of the Roundtable, May 6th, Indian Harbor Yacht Club. Again, membership in the Roundtable is for limited partners, and we are always looking to increase our member. And remember, it's not AUM is the criteria, it's IQ. So, sorry? Plus AUM, that doesn't hurt. It doesn't hurt. And finally, I want to thank Bill Jarvis at the Common Fund Institute. He's head of the research and our newest trustee for sponsoring today's event. Bill, do you want to say anything?
No, delighted to be here.
Great, fantastic. And again, I want to thank our speakers, Andrew, Andy, and Bob. Thanks for coming all this way, and good job.
Thank you.